All right, let's talk about something that sounds like every investor's dream come true. A super simple way to make money when the stock market is tanking. It's called an inverse ETF. But as we're about to find out, this dream can sometimes have a bit of a nightmare hiding inside. We've all been there, right? You're watching your investments grow. Everything's looking great. But then there's that little voice in the back of your head that whispers, what happens when the party stops? How do you protect everything you've worked for? For the longest time, the answers were, well, they were complicated. You had things like short selling or buying put options. This stuff isn't for beginners. It usually means you need a special margin account, and you really have to know what you're doing. But then, a new product came along that looked like an easy button, the inverse ETF. Now, the idea itself is actually pretty brilliant in its simplicity. An inverse ETF is built to be a perfect mirror image of whatever index it's targeting. So, if the S&P 500 goes up 1%, this fund is designed to go down 1%. And if the index falls, the fund rises. The magic behind the curtain? It uses complex financial instruments, derivatives basically, to bet against the market's direction. And you can immediately see the appeal. You get to bet against the market, what they call going short, but you skip all the traditional headaches. You don't need a fancy margin account, you're not borrowing stocks. It looks like the perfect, simple way to protect yourself. Let's just walk through a quick example to make it real. Let's say your portfolio is loaded up with tech stocks, but you're getting a little nervous. You think a downturn might be coming. So you decide to buy an inverse tech ETF. The theory is, if the whole tech sector takes a nosedive, yeah, your main stocks will lose value, but your inverse ETF should go up, which softens the blow. You're hedged. Simple, right?
Well, and this is a massive well, that beautiful simplicity comes with a hidden and very, very steep price. The danger is baked right into how these things actually work, from one day to the next.
And here's the absolute key to the whole thing. It's a mechanism called the daily reset. The best way I can describe it is to imagine you're using a GPS for a cross-country road trip, but every single morning it erases the entire trip and starts fresh. It only cares about getting you to the next town. Its goal for that one day. It has zero memory of where you were yesterday and no concept of the final destination. Because of that daily reset, you get this critical warning. Compounding effects can cause significant tracking errors over longer periods. Now, tracking errors is just a very polite financial way of saying the fund can go completely off the rails and not do what you think it's supposed to do. Let me show you exactly what that means. Okay, let's do the math. Stick with me, it's pretty wild. Say the index and our inverse ETF both start at $100. Day one, the index drops 10%, down to 90. Our inverse ETF does its job perfectly. It goes up 10% to $110. Great. But now look at day two. For the index to get back to 100, it has to go up by 11.1%. Because of that daily reset, our ETF now has to go down by 11.1%. And here's the trap. 11.1% of its new, higher value, $110, is a bigger loss than its earlier gain. The fund drops to just under $98. So just stop and think about what just happened. The index is right back where it started. It's totally flat. But your hedge, the thing that was supposed to protect you, has actually lost money. That's the tracking error in action. And in a choppy market that's swinging up and down all the time, this decay effect gets way, way worse. Over a few weeks or months, the fund's performance can look absolutely nothing like the simple mirror image you thought you were buying. And on top of all that performance decay, you're paying a huge premium for the privilege. The fees for these things, their expense ratios, are just in a different universe compared to a standard, boring index fund. I mean, look at that difference. You're paying nearly 20 times more for a product that can, and often does, fail to do its job.
So let's just hammer these points home. What are the big takeaways here? 1. These are designed for single-day performance. Period. Full stop. 2. They are absolutely not meant to be held for the long term. 3. That compounding math creates those nasty tracking errors. 4. They are expensive. And 5. Because of all this, you have to watch them like a hawk. They are the complete opposite of a set-it-and-forget-it investment.
Which brings us all the way back to the most important question of all. When you factor in the risks, that value decay, and the high costs, should an inverse ETF really have a place in your portfolio? And for the vast majority of regular individual investors, people saving for retirement, for the long haul, the answer is a really clear and unambiguous no. The hidden dangers almost always swamp any potential reward. Let's be crystal clear about this. These are not tools for everyday investors. They're for highly sophisticated professional traders who are using them for ultra short-term bets. We're talking getting in and out within the same day. They're absolutely positively not for someone who's a buy and hold investor or is looking for an easy long-term hedge against a down market.
So I'll leave you with this final thought. When it comes to truly protecting your portfolio, what's the better answer? A complex, high-risk gadget with a bunch of hidden flaws? Or is it a disciplined, boring plan built on proven ideas like diversification and asset allocation? For pretty much any long-term investor, knowing the difference between those two is everything. Thanks for tuning in.